I have been trading profitably for 2 years, and this is only because of my skill of being able to spot and understand liquidity sweeps. Liquidity sweeps are the main part of my strategy, and in this video I will reveal exactly how I trade them so that you can trade them profitably as well. I will go through the basics of what they are, then I will show you the different types, and I will finish with live examples of all of the types of it so you can fully understand them for yourself. So without further ado, let's get into the charts. Okay, so we are on the chart, and the first thing we need to think about is what is liquidity. Now, liquidity, very simply, is just pending orders. Now, what pending orders usually are simply stop losses. So liquidity are areas in price where there are lots of pending orders and also lots of stop losses. Now, there are two major types of liquidity. The first type is internal and the second type is external. So let's just go into an example. So let's say this was how price was moving and we created a price action like so. Now, liquidity is resting orders and stop losses. So where do you think the stop losses would be in this scenario? Well, the stop losses are usually above highs and below lows. So these areas up here would be our two areas of external liquidity, the biggest high and the lowest low. These areas are the biggest areas in price, so this would be our external liquidity up here and also would be our external liquidity down here. And these are simply because these are our two extremes of our range here. So these are the external, the outside bits of this range, and that is where the external liquidity would lie. Now, internally, inside this range, in between these two areas here, so everything in between here, our liquidity would be resting below the lows and above the highs in this range. So we'd have liquidity below that low, liquidity below this low, and we'd have liquidity above this high, and also if price finished here, we'd have liquidity above this high. So these are all examples of internal liquidity. And as you can see, liquidity rests below these lows. Also, you would have liquidity here under this low, and then also liquidity above these highs like so. Now that is the difference between external and internal liquidity. External liquidity is liquidity that is on the extremes of the range, and internal liquidity is liquidity in between the range in an area like this. So if we go back to our diagram over here, let's just dive really deep into external liquidity. So the main areas of external liquidity are areas that have equal highs and equal lows, and this is usually areas of support and resistance like so. So if you have something in price that is moving in a range like this, the common most retail strategy is going to be trading the areas of support and resistance. So you'd have support down here, this would be your support zone, and then you would have your resistance zone up here. Now, as you can see, the resistance zone and the support zone are examples of equal highs and equal lows. So the equal lows would be down here below below the support level. Now, these areas are actually a major area of liquidity. Why? Because if you are trading support and resistance and you're selling at the resistance, where are you told to put your stop loss? So where would your stop loss be? Your stop loss would be above the resistance zone, because if price ever breaks through resistance, you don't want to be in this trade anymore, as your support and resistance is now false and it is not working. So all the stop losses would be above the resistance zone, and again, if you were trading support, all your stop losses would be below the support zone like so. And now, because of everybody trading these support and resistance areas, this means that above the high, above the resistance area, and below the support area, you have a bunch of stop losses. So you have lots of stop losses just pooling together and accumulating in this zone. Now, what do these stop losses mean? What does this actually mean for price action? Well, let's say you were a big institution like a bank or a person or a hedge fund or something like that, and you wanted to sell a bunch of a stock or a bit of forex, a currency, an indice, anything. And in this institution, you needed to place a massive order, an order that is so big that it would not be filled in one spot. Because when we retail trade and we're entering maybe one lot, it will get filled straight away because there's a lot more liquidity in the market than just one lot. But if you're a bank or a hedge fund or a big institution, you're not going to be trading with one lot. You're going to be trading with much, much larger lot sizes. And this means that not all of your trade is going to be placed in one area. And also, your position size is so big, it will actually directly impact the market. So if you're selling a massive amount, the market will actually go down because you're trading with such large volumes, it will have a direct impact. So let's say you were to sell right here at this area. You'd get some orders filled with this red line. Then because of your massive selling, it would push price down even more. You'd then sell more orders down here, and then price would push down even more. More orders would get filled here, and let's say price pushed down one more time, and your last bit of orders got filled there. So you went to sell up here, but your actually average place of sell is somewhere down here in between all of these lines. Now that's not very good because the difference between these two areas can be millions and millions of dollars. So how do banks and institutions try and stop this from having this much spread in their orders? Well, they need to push price into an area where there are a lot more pending orders so that they can fill just in one price or maybe just in a small area of price, not this big range. Well, perfect place would be our stop losses, all the resting liquidity up here. If the institutions could just push price up a bit higher and sweep all of the pending stop losses, they could then fill a bunch of orders. Now, why is this? If you're going for a sell position at resistance and your stop loss is above it, if you are going for a sell, what position is your stop loss? Well, your stop loss is going to be or have to be a buy to buy back the stuff you've already sold. So your stop loss is now a buy. So if everyone's selling at resistance, a bunch or above it would be a bunch of buy orders. Now, if the institution wanted to sell and plummet price, they would have to have people to buy from them. This is because for every seller, there has to be a buyer. So if they needed to sell a bunch of orders, they would have to push price into an area where there were a lot of buy orders, and an area of a lot of buy orders would be above the area of resistance. So if they can manipulate price to then push above the resistance zone, they could sweep all of these stop losses and use all of these pending buy orders to stop everybody out and then fill all of their trades in a sell position, and that means they could get all of their sells in quite a small area like so, and then price would continue to push down after it, and they have all of their orders filled in this small area rather than having one here, one down there, and one down here. You get a much better deal and you can save millions and millions of dollars. So that is the whole concept of external liquidity. It is just stop losses outside of a range like so. And again, this could be opposite for support. They would just push down price below the support and then continue up. So that is the whole concept of external liquidity. Now, very quickly, if you really like the way I teach and you're resonating with my teaching methods a lot, I would like to say I have my own private community, top link in the description. I have hours of private in-depth courses for you to watch, and I will personally review your trading strategy and every trade you take, so I can personally help you to fast track your profitable trading journey. So if you're interested in getting extra teaching and learning from me, that will be the top link in the description. So if we want examples of external liquidity, we can go down to our chart on, this is Euro USD. Now this is just the latest price action of Euro USD, and we could just see where these areas of external liquidity could be found. So if we spot our range and we spot maybe our areas of support and resistance, we see we have a big area of support here, and we'd also have an area of resistance down here like so. Now, as you can see, price had these equal highs here. So if we zoom in, price created equal highs at this zone. And once we created these equal highs, you can see price pushed down off the equal high, came back up, swept above the equal high here, and then as soon as it swept up, it wicked massively and then tanked. This is a prime example where liquidity above these highs was sitting and was a perfect target for these big institutions to then sweep this liquidity, use it to fill orders, to then plummet back down. So that is a perfect example, literally just in the last few hours of price on my chart of where buy side liquidity above the resistance zone was taken. Now, we can also see price created a support zone down here. And as you can see, lots of equal lows. So we had equal lows there. We had equal lows here. We have relative equal lows. So these are called relative equal lows, where lows are very close together, but they're not exactly. These two would be our equal lows. And we'd also have an area of equal lows or relative equal lows down here. So all of these equal lows were just pooling and pooling liquidity. So under all of these lows was just a bunch of sitting stop losses for people who are buying price up. And as you can see, right in this zone, price pushed and swept all of this liquidity completely, stopped everybody out under all of these equal lows and relative equal lows. And after it stopped everybody out, it wicked up massively and then is continuing up now. So these are two examples where equal highs and equal lows were swept and price shot back down to continue in the direction it once was going. So moving on from external liquidity, we have internal liquidity. Now, what is internal liquidity? Now, internal liquidity is usually seen in trending markets. So let's say the price is moving in a bullish trend like so, a bit like this. Now, a common retail strategy is to trade using trend lines like so. So you'd have an area or a line that would be connected by one trend line like so, and this would be an area where you'd buy from. If price ever came back down to this zone, you would then buy it back up. Now, if people are buying at every time price touches this trend line, let's say they went for their long positions here, their stop losses would be below the trend line and also below each one of these lows here. So all of their stop losses would be pooling under the trend line and also below every single higher low in the trend. So you'd have a higher high. Then, of course, you'd have a higher low down here. Then, once again, you'd have a higher high up here, higher low down here, and so on as your basic trending structure. So there would be lots of resting liquidity below these lows. Now, this would be internal liquidity, because if we'd have our major range, so this would be our range, and at the top of our range we'd have the current bit of trend, and on the bottom of our range we'd have the start of the trend. Everything in between this is internal liquidity, which is liquidity between areas in a range or two extremes. So all of our internal liquidity would be below the trend line and below these lows. So what price could be looking to do, and let's say if you're a bank or institution wanting to buy, instead of just buying at price, let's say the trend line like so, or anywhere up here, you'd want to go and sweep a bunch of stop losses to get all of these potential orders to fill your orders to continue the trend going up. Now, what is very common in trends is price doesn't usually just bounce perfectly on a trend line. That would be too easy. Everyone would be making money if that was the case. However, what price does usually do is price likes to come down, create a higher high, come back down, and sweep a previous higher low, like so, sweep all of the resting liquidity under this low, and maybe not just sweep one of these lows, maybe come back and sweep all of these lows, and then continue going up in its bullish structure. Price usually likes to sweep liquidity below the trend line, so break below the trend line, continue, break below a previous higher low like so, sweep all the liquidity under this low, and use all of these new stop losses to then fill all of their orders to then push up and continue in that bullish trend. So internal liquidity is usually within a trend under the lows of a higher low in a bullish trend, and then if you were in a bearish trend, the resting liquidity would be above these areas. Price would then push above these highs, sweep the liquidity to then continue going down in a downtrend. It is the same concept. So if we were looking for an example of liquidity being used like this internally, let's say we go to our Euro USD, the latest bit of price action again, we can see we have a little bit of an uptrend forming like so. So price creating higher highs and higher lows. But if you zoom in closely at every bit where price created new structure, you can see price started reversing down here, came up, created a high, created a higher low, created a higher high, created another higher low, but instead of pushing up above the previous higher high, if we zoom in, we can see price actually broke below this previous higher low like so, because below this higher low, there would be lots of resting internal liquidity. We can see at this area, price actually swept below the low, took this liquidity, and then after it swept this low, continued going up. This is seen again. After price did this, price created a high, then price created a lower high, a higher high up here, and as price came back down, we see we actually swept this lower high again. So once again, we have a lower high, a higher low like here. We'd under this higher low have lots of resting liquidity, and price actually broke below this low, swept this liquidity, and used this internal liquidity to fuel its path in the up direction like so. The exact same happened twice in a row. Now, these are very common patterns, and you can see the more we go along the trend, the more we can see these happening. So price pushed up even higher, created a higher high, a higher low, and before we created another higher high, we created equal lows down here like so. So these would be equal lows. And as you can see, before we pushed up even higher, price once again swept below these higher lows, took out all of this liquidity underneath at this wick, swept this liquidity and used it to push up even higher. So then after that, price then swept more liquidity under this higher low like so. With a higher low, the price then swept the liquidity underneath by this wick and then used it to push up even higher in the trend. So all of these areas, this happened about 4 times just in this small 5-minute trend, where 4 times price swept internal liquidity to then fuel it going back up in price. Now this is so simple to see once you can understand how internal and external liquidity is used in the market, and also you can understand how banks use it to then fill orders like so. So now we know what internal and external liquidity is, we can then talk about how you would draw it on your chart. So personally, how I draw these areas of liquidity is, as you can see, I like to draw these thin black lines. And what I do is you can start on the higher time frame, and I just like to draw, if I get rid of all of these drawings off my chart and start on a blank chart, I usually like to pick a few areas above and below price, which are major highs or lows, either equal highs or lows, or equal lows or relative lows, or anything like that, to then pick as my areas of liquidity. So just using our Euro USD chart again, where would our areas of liquidity be? Well, above price is right here, we have these areas of equal highs. So we have equal highs here, and once again, this would then mean lots of resting liquidity. So if price ever came up into this area, I'd be thinking about, okay, price could sweep this liquidity and then come back down. Below price, what do we have? We have equal lows down here. Once again, equal lows. Below that, in this area, what do we have? We have relative equal lows, because we have a low down here and then a low just beneath it like so. So we have relative equal lows, and below here we have a massive low. This would be our example of external liquidity, and all of these areas in between would be our examples of internal liquidity. So we'd have internal liquidity here, there, and there. Also, this would be our internal liquidity, because above this we have the top of our current range, and this would be our external liquidity. So what could price be doing? If price always likes to go and seek liquidity, let's try and figure out what price could do. Price could break above or maybe break below these lows, sweep out all this resting liquidity, and then use this to push up even higher. Price could also break above these equal highs and then maybe even push up above this external liquidity, sweep this external liquidity, and then use this to fuel and sweep out these equal lows and maybe even get to this external liquidity down here. So this is just how you can use external and internal liquidity together in harmony in your charts. Now, there's one big top secret that I want to inform you guys about when you're trading liquidity grabs, okay, or liquidity sweeps like so. It is very easy to get dragged in from liquidity sweeps because some of these liquidity sweeps could just be a breakout. Okay, let's say price swept liquidity here and then kept going lower and lower and lower. If you bought here, you would have got stopped out. So the secret to liquidity sweeps is you want to see big volume or after your liquidity sweep to prove that price is respecting your area of liquidity. Okay, so let's just say we had a range like this and we pushed out of this range above this area of liquidity. If price swept liquidity and then started slowly moving down like so, I would not class this as a liquidity sweep anymore because we have such boring and slow price action. Whereas instead, if price swept above this zone and then just shot down like so, that's a bit extreme, but then shot down like this in about a few candles, I would then class this as good liquidity sweep. If I can ever spell liquidity, let's just assume that's liquidity because I can't spell. I would then assume this is good liquidity. And the same for the bullish direction. If we swept below these lows and price shot up like so, I would then class this as good liquidity. But if price actually came below this low and slowly started to push up like so, not even being able to break the previous high, I would class this as a bad liquidity and I would not want to be trading it. So that is just a way to like secretly up your win rate just a smidgen, and that smidgen could make all the difference. But other than that, I really hope you guys have enjoyed this video. I hope you guys understand how you can use liquidity, the different types of liquidity, how you can spot it on your chart, how you can draw it, and I hope you guys can then use this to trade profitably yourselves. Now, if you really enjoyed the way I teach and you can learn a lot from me, I heavily encourage you to join my private trading community, which is the top link in the description. I have hours of private in-depth courses, hours of courses just like this about liquidity, about my strategy, about all the confluences I use in the risk management, the psychology. I go even more in-depth than videos like these for hours and hours and hours. And I also give you the opportunity to private calls with me, private mentorships with me, where you can send me your trading strategies, your approaches, trades you take, and I will assess and tell you and analyze them, where you've gone wrong, what you've done right, did you miss anything, like any key areas of liquidity that meant your trade went wrong, are you journaling wrong. I will literally look at your entire trading approach and I will tell you exactly how you can fix it and improve it so you can become a profitable trader just like me. So if that sounds like something you're interested in and you're looking to fast track your profitable trading journey, that is the top link in the description, my Trader Ralph Bootcamp, for you to join right now. Let's trade profitably together today. But other than that, I'll see you guys in the next one. Peace.